Jason, I want to start off with the idea here. At 700,000, you were predicting a slowdown from that blowout number that we had the previous month of 900,000+ jobs here. And I'm curious, what was your general rationale for seeing a slowdown in that rate of growth?
Well, the big thing was that March was partially a pop because of Winter Storm Uri we had in February, which had impacted so many different economic indicators, weighing them down. And even though that job number in February was a good number, the March number picked up some of what probably would have happened in February. And the thought was in April, we were going to get a deceleration because of that shifting around of when jobs were created with that winter weather.
Jason, I think what really stands out is it's leisure and hospitality that are basically carrying this whole thing through. Everything else, you're talking manufacturing, retail, transportation, professional services, education, healthcare. All of those are falling. What is going on in those sectors that you see?
Well, there's a couple of things, right? The economy is opening up, and that's adding the leisure and hospitality jobs that have been holding back. There was also a drop in manufacturing jobs in April, but that's because there was a monster job in March, right? So some of this is give back that we see month to month. There were also some downward revisions aggregated between February and March. So we saw a few different things happening. I think the most important thing, though, in the data that most people aren't looking at is the fact that the number of people who could not look for work in the past 4 weeks because of COVID dropped by 872,000 people. Now, these are people not counted in the labor force because they couldn't look for work, but they couldn't look for work because of COVID. In March, that number was over 3.7 million. In April, it fell to 2.8 million. So that's a really big drop people haven't been talking about. And that's been a big number that's actually making the sort of off-balance sheet calculation of unemployment a lot bigger. And based on our numbers in March, the de facto unemployment rate with that number of people who couldn't look for work because of the pandemic, as well as the misclassification of people not at work for other reasons, would have made the unemployment rate in March 8.6%. And while the normal rate, the published at U3 was 6.1 in March, and it was 6% in March and went up to 6.1 in April, that 8.6, the de facto calculated rate, fell to 8.1 for us in April. So there actually was a huge improvement in the labor force. It's in these special tables that you have to click quite through on the report to get to. But 872,000 fewer people not looking for work because of COVID, that's huge progress.
Huge progress. Is it enough to get us to where Yellen's currently saying, look, we could be back to the sort of unemployment levels we want to see by as soon as next year? But if we're seeing just 266,000 jobs added per month, that's 2.5 years to get rid of that 8 million glut that we currently have.
Well, it depends how you count unemployed, right? If you look at the weekly jobless claims number, there were almost 16.2 million people unemployed in that week ending, I think it was April 17th. That implies, with today's labor force number, an unemployment rate of 10%. Before the pandemic, there were only 2.1 million people collecting unemployment. So, you're looking at 14.1 million people you have to come off of unemployment to get back to where we were before COVID. While I think things are going to get a lot better later this year and next year, I don't think 14.1 million people will be fully off the rolls sometime next year.
Jason, I want to get your quick thoughts here, looking ahead here to some of the economic data folks have their eye on. Of course, we get those two inflation reports next week with the CPI and PPI data. When you look at the inflationary pressures that have already sort of been made evident in the commodity space and the raw material space, do you think we're going to start to see a transfer of that into consumer price data?
Well, I think the biggest thing for the consumer price data over the next few months, this Q2 set of CPI reports, is going to be critical because of the year-on-year base effect. We're expecting CPI numbers averaging between 3.5% and 4% for the second quarter. It's very easy for the Fed to say, don't worry, we're going to leave rates unchanged. We're not going to taper at the rates we've seen recently for inflation. But if headline inflation has an upper 3 handle or a 4 handle on it, that's going to be a tougher argument to make. A lot of that's a base effect. But if that base effect persists for 4 months, which we think is likely, it's going to be very tough to continue to have that story be believed, even if that's the story the Fed continues to tell.